In financial markets, understanding trends is essential for traders and investors. A market trend represents the general direction in which an asset's price is moving over a specific time period. To visualize trends, we use price charts that plot asset prices over time. An upward or bullish trend shows prices making higher highs and higher lows over time. A downward or bearish trend shows prices making lower highs and lower lows over time. A sideways or consolidation trend shows prices moving within a defined range, with neither buyers nor sellers gaining control. Understanding these trend types is fundamental to technical analysis and developing effective trading strategies. Trends are crucial in trading for several reasons. They establish market direction and sentiment, form the foundation for trading decisions, help determine optimal entry and exit points, and guide risk management strategies. Market patterns form naturally as prices fluctuate in response to buying and selling pressure. Patterns form as markets move in waves of price action, creating recognizable formations that reflect the collective psychology of market participants. Market patterns represent the ongoing struggle between buyers and sellers. When buyers dominate, prices rise. When sellers take control, prices fall. Fear and greed drive market patterns, with support and resistance forming at psychological levels. This pattern repetition occurs across different markets and time frames. The double top pattern forms when price attempts to break a resistance level twice and fails, often signaling a potential reversal. The head and shoulders pattern, with its distinctive three-peak formation, is one of the most reliable reversal patterns recognized by traders. Triangle patterns form as price consolidates between converging support and resistance lines, often leading to a powerful breakout movement. These patterns appear across different time frames and in various markets, from stocks to cryptocurrencies. Your ability to recognize patterns will improve with practice and experience. Understanding how patterns form from market psychology provides a foundation for more advanced pattern trading strategies. Trend lines and channels are foundational tools for technical analysis, helping traders identify and confirm market trends. Let's first understand how to identify and draw an uptrend line. In an uptrend, we connect significant low points in the price movement. To draw a valid uptrend line, we need to identify at least two significant lows. These serve as support points for the trend. We draw the uptrend line by connecting these significant lows. This line serves as a support level for the price action. In an uptrend, prices tend to bounce off this trend line, which acts as a support level. Traders often look for buying opportunities when price approaches this support line. Now let's examine how to identify a downtrend line. In a downtrend, we connect significant high points in the price movement. For a downtrend line, we need to identify at least two significant highs. These serve as resistance points for the trend. We draw the downtrend line by connecting these significant highs. This line acts as a resistance level for price action. In a downtrend, prices tend to be rejected from this trend line, which acts as a resistance level. Traders often look for selling opportunities when price approaches this resistance line. Now let's explore price channels, which are formed by drawing parallel trend lines that contain price movement. An upward channel forms when we can draw two parallel lines, a support line connecting the lows and a resistance line connecting the highs. To create a channel, we first identify the significant lows and highs in the price movement. We draw the lower support line connecting the lows, and then draw a parallel resistance line that passes through the highs. These two parallel lines form a price channel. Within a channel, prices tend to oscillate between the upper and lower boundary lines. Traders often buy near the support line and sell near the resistance line, capturing the price movements within the channel. Let's now examine trendline breaks, which can signal potential reversals or continuation patterns. Consider an established uptrend with a clear support line. The price has been respecting this trend line with multiple touches. We can identify the uptrend by connecting significant lows, creating our support line. But what happens when price breaks below this established trend line? This is called a trend line break. A break below an uptrend line often signals a potential trend reversal. Traders look for confirmation of the break with increased volume and follow through price action. After a break, the previous support line often becomes a new resistance level. Notice how after the breakdown, the price retests the previous support line, which now acts as resistance before continuing lower. This is a common behavior after trend line breaks. Finally, let's explore how traders use trend lines and channels to make entry and exit decisions. Consider a price channel where we've identified both support and resistance lines. Traders use channels to identify optimal entry and exit points. The support line offers potential buy signals, while the resistance line provides sell signals. Here we can see potential buy entries when price touches the support line and sell exits when price reaches the resistance line. A basic channel trading strategy involves buying near support with stops placed just below the support line and selling near resistance with stops just above the resistance line. Traders should also watch for potential channel breakouts, which may signal a change in the trend. Stop-loss orders are typically placed just below the support line for long positions, protecting traders if the support fails. To summarize what we've learned about trend lines and channels, uptrend lines connect lows and provide support, while downtrend lines connect highs and act as resistance. Parallel trend lines form channels that contain price movement. Breaks of these lines can signal potential trend changes. And traders use these tools to identify optimal entry and exit points in the market. Reversal patterns are price formations that signal a potential change in the current trend direction. These formations typically appear at the end of established trends and represent fundamental shifts in the balance of supply and demand. It's crucial to wait for confirmation before acting on these patterns. The head and shoulders pattern is one of the most reliable reversal formations. It consists of 3 peaks, with the middle peak, the head, higher than the 2 surrounding peaks, the shoulders. The neckline connects the lows between the peaks and acts as a support level. When price breaks below this neckline, it confirms the reversal pattern. When the price breaks below the neckline, traders look for further downside movement. The typical price target is often calculated as the distance from the head to the neckline, projected downward from the breakdown point. The inverse head and shoulders is the bullish counterpart, appearing at market bottoms. It's essentially a mirror image of the standard pattern, with 3 troughs instead of peaks. The neckline in this case connects the highs between the troughs and acts as a resistance level. A breakout above this neckline confirms the bullish reversal. When price breaks above the neckline, it signals a potential trend reversal to the upside. The measuring technique is similar, the distance from the head to the neckline projected upward from the breakout point. Double tops and double bottoms are among the most recognizable reversal patterns. A double top forms when price reaches the same resistance level twice and fails to break through. Similarly, a double bottom occurs when price tests the same support level twice before rebounding. These patterns represent 2 failed attempts to continue in the original trend direction. The psychology behind these patterns reveals how market sentiment shifts. The first test of a level may be viewed as normal profit-taking or dip buying. But when price returns to test the same level again and fails to break through, it shows a loss of conviction in the prevailing trend. When price finally breaks the support level in a double top or the resistance level in a double bottom, it confirms the reversal pattern. Rounding patterns, also known as saucers, represent gradual shifts in market sentiment. Unlike the sharp reversals we see in head and shoulders or double patterns, these develop over longer periods. A rounding top forms as buying momentum slowly dissipates and sellers gradually take control. It creates a downward arc as the price slowly rolls over and heads lower. A rounding bottom conversely forms as selling pressure gradually decreases and buyers slowly return to the market, creating an upward arc. Volume often provides important confirmation for rounding patterns. Typically, volume decreases in the middle of the pattern and increases as the pattern completes, confirming the new trend direction. Identifying reversal patterns is only the first step. Proper confirmation is essential before taking action. Let's examine the key signals that confirm a reversal pattern is valid. The first confirmation signal is a decisive price break through a key support or resistance level. This break should occur with increased trading volume, showing strong conviction in the new direction. Often, price will retest the broken level. In a head and shoulders pattern, for example, price might return to test the neckline from the other side before continuing in the new trend direction. Not all reversal patterns lead to successful trend changes. Let's compare a successful pattern with a failed one to understand the differences. In a successful pattern, we see a clear breakdown below support, followed by continued movement in the new direction. Volume typically confirms this move. In contrast, a failed pattern might initially appear identical, but instead of breaking down, price bounces at support and continues in the original direction. This is often called a fake out or false breakdown. There are several reasons why patterns fail. Insufficient volume on breakouts, strong support or resistance levels, external market influences, premature entries, and false breakouts can all lead to pattern failures. This is why waiting for proper confirmation is crucial when trading reversal patterns. Patience and discipline in waiting for clear confirmation signals significantly improve the reliability of these chart formations. This section explores how chart patterns behave across different timeframes. Chart patterns appear across all timeframes, from intraday charts to monthly views. The same market can display completely different patterns depending on which timeframe you analyze. Patterns on longer timeframes generally produce more reliable trading signals. Here we see the same head and shoulders pattern across 3 timeframes. Notice how reliability increases as we move from shorter to longer timeframes. Multiple timeframe analysis is a technique traders use to confirm patterns and improve decision-making. Let's examine how to confirm a trend using 3 different timeframes. First, identify the primary trend on a higher timeframe, such as the weekly chart showing a clear bullish trend. Next, confirm the intermediate trend on the daily timeframe, which also shows bullish momentum. Finally, look for specific entry setups on lower timeframes, such as this triangle pattern on the hourly chart that's about to break higher. When multiple timeframes align like this, you have greater confidence in your trading decision. Here, the weekly and daily uptrends confirm the bullish bias for the hourly triangle breakout entry. Remember that higher timeframe patterns often influence and override signals from lower timeframes. This is why professional traders always consider multiple time horizons before making trading decisions. Volume plays a critical role in technical analysis by validating chart patterns. Volume measures trading activity intensity, acts as a confirmation tool, validates pattern signals, and often precedes price movement. During pattern formation, volume typically declines as the market enters a consolidation phase. This declining volume indicates a period of uncertainty and diminishing conviction among traders. Valid breakouts are characterized by a sharp increase in volume as the price moves beyond the pattern boundary. This surge in volume confirms that traders have conviction in the new direction, validating the breakout signal. False breakouts occur when price breaks a pattern boundary but is not accompanied by sufficient volume. When volume remains low or even declines during an apparent breakout, it signals a potential failed breakout, and price is likely to reverse. Volume often acts as a leading indicator, changing before price confirms a new trend. An increase in volume before a price breakout can provide early entry signals and shows shifting market sentiment. When analyzing volume, follow these best practices for more reliable pattern confirmation. Note that while volume behavior may vary between different pattern types, the principle of increasing volume on valid breakouts remains consistent. Remember these key insights about volume and pattern confirmation. Fibonacci retracements identify potential support and resistance levels where price patterns often form. The Fibonacci sequence starts with 1 and 1, where each subsequent number is the sum of the two previous numbers. This mathematical relationship forms the basis for powerful market analysis tools. The most important Fibonacci retracement levels are 38.2%, 50%, and 61.8%. The 61.8% level, derived from the golden ratio, is considered the strongest. To apply Fibonacci retracements, we identify significant swing highs and lows on the chart. Drawing the Fibonacci retracement levels from the swing low to swing high shows potential support areas during price pullbacks. Notice how a double bottom pattern forms near the 61.8% Fibonacci retracement level, providing a strong reversal signal. Traders use Fibonacci retracements for multiple aspects of trading decisions. They identify potential entry points at key retracement levels, set stop losses below deeper retracements, and establish profit targets at extension levels. The mathematical basis for Fibonacci retracements comes from the golden ratio, approximately 1.618, which appears throughout nature and human behavior. For best results with Fibonacci retracements, use multiple time frames, combine with other indicators, look for candlestick patterns at key levels, and always wait for price action confirmation before entering trades. Pattern trading strategies require effective entry techniques, risk management, and profit-taking approaches. Let's examine 3 key entry techniques for pattern trading. Breakout trading involves entering when price breaks through key support or resistance levels. Here's an example of a breakout trade. Notice how the price consolidates at resistance before breaking out. The entry is triggered when price convincingly breaks above resistance. Pullback entries involve waiting for price to retrace to a key level after a breakout, providing better risk-reward ratios. In this pullback entry example, we wait for the price to retrace to the trendline support before entering the trade. This provides a better entry price with a tighter stop loss. Anticipatory entries involve entering trades before pattern completion, providing better entry prices, but with higher risk. Here, we anticipate a breakout from a cup and handle pattern. By entering before the pattern completes, we get a better entry price, but we risk the pattern failing. Effective risk management is critical for successful pattern trading. Proper stop placement is essential to protect capital. For breakout trades, place stops below the breakout level or the most recent swing low. Position sizing determines how many shares to trade. The key formula is to divide your account risk by your trade risk. For example, with a $10,000 account and 1% risk, you'd risk $100. With a $2 stop distance, you would trade 50 shares. Setting appropriate profit targets is essential for maximizing trading success. There are several methods for setting profit targets in pattern trading. Let's look at the most effective approaches. Pattern measurement involves projecting the pattern's height to determine price targets. For example, in a head and shoulders pattern, we measure the height from the head to the neckline, then project that distance below the neckline to set our target. Using multiple profit targets helps manage trades more effectively. A multiple targets approach involves taking partial profits at different levels. For example, you might close 1/3 of your position at each target. This balances securing profits with allowing winners to run. Let's analyze complete pattern-based trades from identification to exit. Let's analyze a bull flag breakout trade. The pattern forms after a strong uptrend creates the flag pole, followed by a consolidation period forming the flag. We enter on the breakout above the flag, place our stop below the flag's low, and set our target based on the flagpole's height. To summarize our pattern trading strategies, remember these key points. Choose entry techniques based on pattern type and risk tolerance. Always define risk before entering trades. Set clear profit targets. Use proper position sizing, and combine pattern trading with volume confirmation. Let's examine the common pitfalls in pattern recognition and best practices for traders. First, let's discuss common mistakes traders make when identifying patterns. Many traders fall into the trap of forcing patterns where none actually exist. This leads to poor trading decisions based on false signals. Patience is critical when trading based on chart patterns. It's essential to wait for patterns to complete before entering trades. Let's compare the difference between impatient and patient trading approaches. Impatient traders enter too early before the pattern completes, while patient traders wait for full confirmation. There are several effective ways to improve your pattern recognition skills. Regular practice and documentation are key. A pattern trading journal helps you track your observations and results. Record both successful and failed patterns to learn from your experiences. Pattern trading involves significant psychological challenges. Being aware of these biases helps you maintain objectivity. Finally, let's review best practices for incorporating pattern analysis into a comprehensive trading approach. Remember that patterns represent probabilities, not certainties. Developing your pattern recognition skills takes time and practice, but can significantly improve your trading results.